Market narratives often frame Masayoshi Son as a gambler. Institutional data reveals something different, a layered system of predictable, mechanical mispricings. Since 2018, sophisticated hedge funds have systematically exploited 5 specific trades within this system. Every execution relied exclusively on public SEC filings, earnings transcripts, and investor relations releases. Hedge funds treated SoftBank as a tradable ecosystem where extreme corporate transparency intersected with rigid structural flaws. Trade 1 targets the top of the capital structure. SoftBank Group, the corporate entity, chronically traded below the aggregate value of its listed portfolio holdings. This chart shows the peak of that divergence. In early 2020, Masayoshi Son confirmed live on an earnings call the stock traded at a 73% discount to its net asset value. The market priced $1 of SoftBank's listed assets at exactly 27 cents. Elliott management utilized a repeatable activist formula. Buy the stock at this extreme discount, then apply public pressure to force share buybacks or asset sales. Extreme NAV discounts function as tripwires. Activist pressure triggers capital returns and mechanically compresses the spread for massive single-day gains. Trade 2 maps a structural flaw in the Vision Fund. A mandatory 7% annual coupon on outside capital forced SoftBank to deploy an average of $55 million into startups every single day. This velocity mandate sacrificed competitive discipline. To show interim paper gains, the fund wrote late-stage rounds at severely inflated private valuations. Trade 3, the IPO short, capitalized on the inevitable repricing. Companies like WeWork and Uber collapsed as they hit public markets, measured against GAAP reality. SoftBank's WeWork position alone saw a 94% destruction of peak value. Modeling these shorts required mapping S-1 financial disclosures against the mathematical reality of the Vision Fund's relentless coupon obligations. Trade 4 tracked SoftBank's internal trading unit. A $4 billion spend on call options created the NASDAQ whale gamma loop, mechanically forcing market makers into a massive delta hedging buying spree. Trade 5 involved the Alibaba prepaid forward callers. SoftBank monetized its Alibaba stake through variable contracts, creating a different set of mandatory dealer mechanics. Counterparty banks like Goldman Sachs and UBS were structurally forced to short Alibaba from the moment the contracts were signed. Their short position persisted until physical share delivery extinguished the hedge. Sophisticated funds extracted yield by identifying these massive derivative positions and writing the mandatory hedging requirements of SoftBank's counterparties. Masayoshi Son's earnings calls provide a highly reliable trading calendar. He is exceptionally candid, often quantifying portfolio distress and peak discounts live, in public, with no delay. These public admissions act as leading indicators for imminent forced selling or massive buybacks, frequently generating immediate double-digit stock pops. Generating alpha in the SoftBank ecosystem relies on the rigorous discipline to model public disclosures. Direct institutional viewers can find the full trade note and catalyst calendar on the Mathematical Trader Patreon.